Howdy, Jacob here. Today we're looking at Dollarama in the broadline retail industry, Toronto business, 36.4 billion market cap on 38.4 billion enterprise value, headquartered in Mount Royal, Canada, founded in 1992. They sell general merchandise, consumables, and seasonal products. We do see a very consistent, heavy revenue increase, double digits. That's amazing. 2.3 billion in revenue in 2015 all the way to 5.9 billion in 2024. Increase on the gross margin side, increase of operating margin with an operating margin of 20 to 25% for retail is absolutely insane. Huge increases in earnings per share. Their dividend is very low, really a very low payout, and the ratio or the yield is 0.3%, but from a payout ratio, they have a lot of capital allocation left to reinvest, which sounds amazing with the 20% plus return on invested capital and return on assets. That is an absolutely fantastic rate of return on the assets and investments into the business. And so you'd want this company to be reinvesting a lot as long as they have the capabilities to grow within their investments. 314 million cash on hand with 21 million short-term debt, 2.2 billion long-term debt. That 2.2 billion debt, long-term debt in relation to free cash flow is less than 2 years. So we're definitely not concerned about that. Growth on free cash flow is phenomenal. So in reality, if they were to double, the way I think about debt is if it's 2 years right now, they keep their debt the same, but double their free cash flow, then it's just 1 year. Because again, that ratio, the numerator portion or the denominator portion can definitely increase, making that ratio less by having a free cash flow much greater. And so not concerned with that debt figure whatsoever. Their use of capital allocation is mostly share repurchases. So I've talked about this in the past. When you have a high return on invested capital, but all you do is buy back shares, pay a dividend, you don't necessarily deserve that huge premium that a company with a high return on invested capital that's actually reinvesting back in themselves deserves. And so again, if you get a 20% rate of return on the money reinvested back in your business and you invested 100% and you got that historical rate of return, you could grow your business 20% or grow your earnings and free cash flow 20%, which is phenomenal. But if you only lose half of it, then it's 10% plus the organic growth that you have. And so here, we're really not seeing a whole lot of money being reinvested. We're seeing less than 5% of money reinvested back in the business, maybe 5 to 10% for acquisition. Their dividend, maybe 10%, and then share repurchase is going to be a huge portion of that. And so when we go to make our own assumptions, we're going to be assuming that a lot of capital allocation is for share repurchases, because that's, again, what you want to balance what they've done historically with what you want them to do. And it sounds like if they have a 20% rate of return on invested capital, that number is inflated by repurchasing shares, because, again, the denominator portion of that is going to be your equity, assets, and the money that you have available to reinvest. And so when you repurchase shares, you're lowering the denominator, increasing the return on invested capital figure. But either way, still a fantastic rate of return. But again, if they're not reinvesting it, they don't necessarily deserve that premium. So let's get to it. Looks like they've been growing absolutely astoundingly. If we think that they can keep growing at 10%, I think they deserve a 22p price free cash flow just because they're so consistent with everything. 15, 18, I like that. We'll do exactly what we see on the averages there. For share repurchases, 1% for them is about 364 million. 2% then would be about 700 plus million. That's about 70 to 80% or 70% of free cash flow. That's pretty much what they've done historically with their low amount of stock-based compensation in relation to that. So I think that's fine. The dividend, have they increased that in the past? Because right now it's just under 10%. Okay, I'm fine with that. We'll increase their dividend at 10%, keeping the capital allocation roughly 10% of total free cash flow. So this is assuming about 70% of money goes to share repurchases, 10% to the dividend, leaving about 20% available to make acquisitions that are efficient, reinvesting back into yourself to get that massive rate of return, or to pay down debt if they want to deleverage. And so right now it's a fantastic business. I will take no disrespect to I give no disrespect to this business and what I'm seeing from the numbers perspective, but from a valuation perspective, it does look a bit frothy. I do think it needs to fall in half before you get the return we're looking for here. However, I will say companies that are this immense and have fantastic growth and are still very solid deserve a premium. I think that you can buy them for what looks to be a more expensive price. I'm not saying this is the price, but you can get them at a price that looks kind of expensive from a free cash flow calculation standpoint or earnings calculation standpoint and still get a great return if you know the business is going to be around for 20 or 30 years and they're able to grow at 10% a year for the next 20 or 30 years. I just don't know this business. I don't understand it well enough to be able to say that that's a for sure. And I like to do my calculations in 7-year basis in a 7-year basis, saying that the average time between trough to trough or peak to peak of a cycle in America is roughly 7 years. So I like to do a 7-year analysis. And also anything beyond 10 years, I do get skeptical about a lot of businesses really being around and knowing that they're going to be around. And so for me, right now, fantastic business, just one that I want to get at a little bit more attractive price. So I hope you enjoy the video and have a great rest of your day. Thanks.